Hello everyone, in this video we will take a look at the Stillfront Group stock. We will take a look at the fundamentals and do some analysis of the company. So let's get into it. So the Stillfront Group is listed under the ticker symbol SF.ST at eToro. It is a digital game developer and publisher, and it is a Swedish headquartered company. It was established at 2010 and throughout its life it bought several other game publishers. When we take a look at the games that this company develops, there is plenty of quite famous games. For example, this Call of War is quite popular, as well as this Conflict of Nations. This Big Farm game is quite popular, and there are of course many other games that this company actually develops. Shakes and Fidget is again one that's quite popular, and they have plenty of games. This is just the featured games. They have many more developed and owned by this company. When we take a look at their business operations, they describe themselves as a company that acquires and develops game studios for the purpose of creating a diverse portfolio of games with strong IPs. Their titles are typically long, lifecycle games with a loyal user base and stable revenues. The active portfolio generates revenues every day, consists of more than 75 games divided into 3 product areas: strategy, simulation, RPG and action, and casual and mashup, which is 4, but that doesn't matter. What matters to me as an investor is what moat does the company have? What is the competitive advantage this company has against other competitors? And frankly, I just cannot find one. When we think about it, this company is developing games. They have 75 games. Sure, that's very nice. But what prevents some group of software engineers from starting a company that will develop similar game and actually compete with this company? In my opinion, not much. I am a software engineer myself, and I would say I can develop some of those games in a few months period. I can understand their small competitive advantages that when they make one game, the other games that they make, they can essentially build on top of the code that they already wrote. So it's a little bit simpler to develop new games. And in my opinion, they really leveraged the games that they've created and created more games on top of the existing architecture. And that's why they have 75 games. Of course, they are quite successful with their games. They have approximately 64 million users all over the globe enjoying their games. When we take a look at the shareholder structure, what I would like to see is the management of the company or the founders that are still involved in the company to have some larger position in the company, to have approximately 10% of the company in shares. That means they have some skin in the game, and their decision will be the best decision for the long term for the company. But what I see in here is pretty much all of the top 10 position, it's just some funds. I don't see any sort of skin in a game from the management. So the shareholder structure could be better, but it's still no red flag. Most of the companies actually don't have the founders owning a large percentage of the company, or the management for the fact. So even though I would prefer that, it's not a deal breaker for me personally. So let's take a look at the results for the third quarter of 2022. We can see that the company grew its revenue by 36%, which is a huge growth for the company. It's a very nice thing to see, especially in this sort of market where many companies, the big tech especially, are having problems growing anymore. For example, Facebook, they reported a decline in revenue, and many other companies reported a decline in revenue. And it's very nice to see that this company, even though we've had pandemic here, even though there was lockdown and people played games probably a little bit more than expected, still this company grows 36% compared to that exceptionally good year. So this is very nice thing to see. They obviously have some positive FX effect, especially because of the strong US dollar. Remember, this company is based in Stockholm in Sweden, so they will have some benefits from strong dollar, especially because 46% of their sales comes from North America. Europe is the second, 24%, Asia the same, 24%, and then the other continents are just a few percentage. So when we compare this quarterly results with the other quarters, we can see that, yeah, there was a 36% growth year over year, but when we compare it to the previous quarter, we can see a decline in revenue. And it's true that the growth of this company is much higher than the underlying mobile games market. When we take a look at other companies like Electronic Arts or Activision Blizzard, these companies, they are starting to have problems growing actually, and the growth of the overall mobile games market will be like 5, 6, 7%. So it's not a huge growth, and when we compare it to this 36% growth year over year, it's much better number. The interesting thing, and the thing that is not that exciting for me, is that the number of monthly active users is actually only 6% up year over year. So that means they were not able to grow their user base as much as their revenue. And it essentially means that on one hand, yes, the company could or learned how to squeeze more money from the customers or the users that they already have. On the other hand, it means how is the company supposed to grow if at the end it will be grown by the amount of users that are playing their games, right? In the end, long term, the company will the revenue will be somehow in line with the number of active users. When we take a look at the cash flows, it actually seems that the company is growing the cash flow from operations only by 3%. And when we take a look at the last 12 months, trailing 12 months, and take the most recent quarter and the quarter year ago, it seems like the free cash flow actually declined by 1%. When we actually take a look at the balance sheet of this company, we can see that the company has a lot of assets, but the current assets, it's a very small amount compared to the total assets. It's only 1.8 billion euros. And if we take a look at the current liabilities and the debt they have, it's actually much larger. It's 2.8 billion, which means that the company will likely have to borrow some money or issue some shares in order to be able to pay off their current liabilities, which either way for the shareholder is not a great thing to see. And in general, when we take a look at the long-term debt, I would say, first of all, the company is growing their long-term debt at quite high pace. I would say it's currently sitting at around $4 billion, which for the company that is trading for like $10 billion, it's quite a lot. Of course, if we take a look at the free cash flow, they are making less than $1 billion in free cash flow. So it's like 900 millions of free cash flow. They should be fine. They should not bankrupt or anything, but they will probably have to get some more money and then start paying off this debt. And when we take a look further down at the balance sheet and the total assets of the company, we can see that the goodwill and other intangible assets are sitting at almost $18 billion, which is a huge number, especially for the goodwill, which is larger than the market cap of the company. In my opinion, this balance sheet is not good. It's not good. First of all, the company will probably have to issue more shares or get additional debt, additional financing. And you probably know how high the interest rates are right now. So yes, the company was spending a lot of money on acquisitions, as you can see by this huge goodwill that they have on their balance sheet. It depends whether the acquisitions were as good and at a good price. I think we will have to find out. Of course, the acquisitions mean that the company will be growing the top and bottom line, right? It makes sense. When they are acquiring more gaming studios and developing more games, they should have more active users and they should generate more revenue and more net income. Thus, they should be able to pay off the debt. But based on the current amount of monthly active users, it doesn't seem to be growing that much. It was up 6% year over year, which is not a lot when we compare it to revenues and to other metrics. This company is benefiting a lot from the FX exchange. The US dollar is just very strong and the company is benefiting a lot. So the company is growing their revenues quite rapidly. They are acquiring more studios, more game developing studios, they have more games, and they have quite stable user base, they have quite stable free cash flow. You could say this company is a value stock. The market cap is about 11 or 12 times their yearly free cash flow. But in my opinion, there are two red flags with this company. One of them is that I'd like to buy a strong business with some competitive advantage. Frankly, I just don't see it in this company. In my opinion, this company develops interesting games. As part of the research, I actually played one game this company develops, and it was very sticky. It was fun to play, so I enjoyed playing the game. But I still have issue with the fact that a group of random people can today, just like that, start competing with this company. They can develop their game in a month or two, and it can be a very similar game to the game that this company has. So in general, barriers of entry is quite low, and I don't see much of a competitive advantage this company really has. The second red flag, in my opinion, is the balance sheet of the company, which doesn't look good. I mean, they have a lot of goodwill and intangible assets, which makes sense because they are doing a lot of acquisition of software development companies. So by default, they will have a large amount of goodwill, but still, I would say they have a lot of long-term debt. They will probably have to issue more stocks or take on more debt in order to finance their current liabilities. So even though this company is down significantly from their all-time high, which was $112, it's now trading at around $19. It could be considered a little bit of a value stock based on the price to free cash flow it is trading at. I still cannot invest into this company because of these two red flags that I can see. So I hope this video was beneficial for you. If it was, please like the video. You can share it with other people if you want. Subscribe to this channel for more videos like this one, and I'll see you next time.